Today on the Five Guys, we are covering the top write-offs for all LLC owners in 2024, including the 5 that all LLC owners should be doing no matter what. And we'll also be covering every single tax deduction that you can take moving forward. We're the Five Guys. Let's get started. All right, Dom. So today we're going to be talking about write-offs for LLCs. Now, remind me if I'm correct in thinking, do you have an LLC for your company?
I do have an LLC. We are LLC brothers at this point. Do you have an LLC or are you rocking an S corp?
No, I mean, well, S corp is just a portion or is a additional election on top of an LLC. So yeah, I have an LLC with an S corp election.
Oh, okay. I always hear like, if you're making above 50,000, you should have S corp and like all these different things. So it's kind of confusing a little bit. Maybe we should do a whole podcast on structuring LLCs and whatnot like that. But
yeah,
okay.
that could probably be a good one. Though that is a little confusing. My general rule of thumb is if you're over $60,000, then it probably makes sense to do an S corp. And the big difference with an S corp and an LLC, and there's a bunch of different things, but one of the major ones is that if you have an S corp, you have to do payroll. If you don't have an S corp, you do not have to do payroll. Yeah. So I have to pay myself, since I'm a sole employer. I have to pay myself from my business, but it helps me save on employer taxes.
Yep, absolutely. Well, I'm excited because you know me, I love cutting costs. I love a good write-off. And we should probably define write-off. I know a lot of people, probably if you clicked on the video, are a business owner or are hoping to be a business owner. But when people say like, hey, Chris, I bought this car, I bought this laptop, I'm gonna write it off, right? It's free. No. It's not free. It's just, getting taken off the taxes, right? Do you want to go a little bit more into that?
Yeah, I think that's really important. I think it's funny that you mentioned that because there's a bunch of people that think that like, oh, hey, I'm going to buy this new car for my business or whatever. And I hear that you can write off 100% of the vehicle if it's for business use. So it's basically like I just bought a free car. And I think a lot of people think that way, right? If like, oh, just take your clients out to lunch. Like you get to write it off anyway. So it's a free lunch. Yeah. And that's completely wrong. It's just completely wrong.
Yeah, it's not right. It's not. It's like it's a tiny bit correct, but it's not correct at the same time. It's weird.
Yeah, it's like you're spending $100 to save $25. That's the way I think about it. Yeah. But a tax deduction or quote unquote a tax write-off is an expense that you can deduct from your taxable income, reducing your overall tax bill. So the IRS has criteria that the expenses must qualify as deduction. So let's just give an example for this. Say that Joe is self-employed and he's a writer, and then he wants to save $1,500 in taxes, and his marginal tax bracket is 25%. That means he needs to find $6,000 in deductions in order to save $1,500 on taxes. So with that being said, say I want to buy a new camera for the Five Guys podcast. Now, my wife has said, Chris, I want to buy a new camera. Why don't you just go and buy one for your podcast, and then we'll use it in general. And then I say, well, that cameras cost a lot of money, and right now I don't really want to spend that because I have a camera. And she goes, well, Chris, it's just a tax write-off, so it's basically free. And I had to explain to her that if I go and I buy $1,000 camera, I buy that $1,000 camera, that now takes $1,000 out of what I get to report to the government. But that only means that I save myself maybe $200 in taxes. So I had to spend $1,000 to save $200 in taxes. So there's a very big difference between a tax deduction, which would be a write-off or a credit, versus a tax deduction and a tax credit. I think a lot of people, they confuse the things.
Yeah, it's kind of funny, the idea of spending $1,000 to save 200. Kind of a weird concept, because it kind of encourages you to buy things that you might not need. It's the same concept with a sale, right? It's like, oh, we saved so much money on this sale. It's like, you still spend money. Like, if you wouldn't have bought it, we would have had more money. So did we save? I don't know.
Yeah. And some people, unfortunately, like business owners, they'll mess this up a lot. And they'll think like, oh, as long as I'm reinvesting in the business, then it's okay. But let's just take that example again. So I want to buy a $1,000 camera. I could either wait till the end of the year and pay myself $1,000 and then have to pay $200 to Uncle Sam. So I could either net $800 and make $800 to myself, or I could buy a new camera where I'm not going to pay any taxes on it, but now I net nothing to myself. Now I have a new camera.
Yeah. Yeah, exactly. Exactly. Yeah, it's a it's a wild thing, the tax code, and writing
Mhm.
things off, and you got to know it. You got to know it if you're a business owner. Or at least hire someone who does know it. But it's good to know the basics. It's always good to know the basics.
Yeah. And that's what today's podcast is going to be. It's just going to let go over all of the ones. And my goal at the end of this is that our listeners, if you do have an LLC and you're thinking like, what things can I write off? Go and get yourself a qualified CPA. Like find someone who you can work with. But it's also good that you know these things so you can bring it up to your CPA. Because if your CPA isn't bringing it up to you and you don't know it, then those things get swept under the rug. Because some of these startup costs or sometimes the vehicle expenses or some of these write-offs that you can do, they're a little complex. And maybe you have a CPA that isn't the best CPA and they don't want to do all the extra work to figure out what's the best way to deduct. Without you being your own advocate and coming to your CPA and saying, hey, why don't we write off these organizational costs or write off this vehicle or do this or that? If they don't bring it to you, how are you going to know?
Yeah. Yeah. Basically. And you know what's weird about this? Like, not you would expect a CPA to like know everything about the tax code, like all the hacks, all the loopholes. They don't.
Nope.
Like they just don't. And it's weird. I can't think of an analogy, a good analogy, but it's like a chef being like, Chris, you're a chef, right? And I'm like, Chris, private chef. I'm like, Chris, can you make us sushi? And you're like, I have no idea how to do that, right? Like, but you're a chef. You should know this. It's like, well, there's a billion different meals to create in the world. How would I know? So
Yep.
make sure you get one. Like, say if I'm in real estate, right? You're gonna want a CPA that works with people in real estate, so they know how to, take accelerated depreciation and all these different real estate things for depreciation and tax advantages. Because that's one of the main reasons why people do get into real estate, besides cash flow. But I'm getting off track. But yeah, not all CPAs are created equal, like
Mm-hmm.
anything.
Yeah, it's kind of like working with a generalist or working with a specialist, right?
Mm-hmm.
If
Yes.
if you need a knee surgery, you don't go to your family doctor who checks your blood and everything. Like, hey, your BMI is a little off. You're not going to say, hey, my knee's broken. You want to go ahead and cut me
Oh,
open and
exactly.
fix that? No, you're going to
Yeah.
go to a knee surgeon to get
Yeah.
that fixed. It's the same reason I don't go to IHOP and ask for filet mignon. Like, they're just two different things. So,
Yeah. Have you ever had an IHOP steak? I'm pretty sure they serve steak there.
I've never had IHOP. No, I always get the breakfast sampler. That's my ish.
Gotcha. I don't know if it's Denny's or IHOP, but I always get the Grand Slam sandwich.
That's Denny's.
That's Denny's. Okay, well, damn. That it is. Anyways, got me talking about food again. Happens almost
Yep.
every pod. I got to start eating before the podcast. Getting in here and be all hungry. Anyway, okay, so let's continue the conversation. What's next?
Yeah. So we just realized what a difference between a tax deduction is and a tax credit. So again, a tax deduction just means you tell Uncle Sam like, hey, I spent $1,000 on whatever it is. That means that what I get to report to you is $1,000 less. So it doesn't mean that it's free in any way, shape, or form. It just means that you're getting a tax deduction. And remember that most people's their tax rates somewhere in the 20 to 30%. So every time that you're spending money, you're saving yourself 20 to 30%, not 100% of whatever you're doing. So right now I want to go into the top 5 tax deductions that every new LLC owner for 2024 should be taking. And then we'll go through every single thing. And then I'll go a little bit deeper into all of the different ones you can write off at the end here. So stick around to the end if you want to hear every single one, but let's go over the top 5 that everyone should be doing.
Perfect.
And number 1 is startup and organizational costs.
People don't factor it in. You can write that off.
Yeah. Now, do you remember when you started your first LLC? Did you do it all by yourself, or did you have a service do it? Did you do any research?
I had a CPA do it. Yeah.
Okay. And did you have that CPA? Did you write off all those legal fees of them doing all that for you?
Yeah.
Good.
Yep. Dude, it's funny. Like once you've done something once, you have the foresight to know how it's gonna go. And honestly, if I was gonna start up a company again, I don't know if I would use it because it was so much money. It was a ridiculous amount. And I can just like go down to like City Hall and just do it myself, as long as I know what I'm doing. Oh man, I don't know. You'd probably hire someone, wouldn't you, Chris?
I hire people to do it. Yeah. So, I mean, I just do it online services. I think Monzon Wealth was started by Zen Business.
I've heard about them. Today's sponsor.
Yes.
Imagine.
Sponsored by, no.
Sponsored by Zen
Yeah,
Business.
mine was Zen Business because they had a thing where they could get the LLC. They would also be my, what's it called? It's like a point of contact. I can't remember what it's called. There's like an official word for it. And then also they had my website thing all went through, like, is all in one place. So I like that service of being able to do it all there. But whenever you are starting up a business, you have to remember that there's more than just the formation fees of just forming the LLC. Sometimes you need to get legal fees done. You need to have things drafted up if you have a partnership. That can be a tax write-off. Feasibility studies, like some people, they need to go around and they need to actually do research, market research, to say, hey, before I start this LLC, is there a value? Is there like a business that can actually be started out there? Because just because you have an idea in your head of that this could be a good business, it might not be a good business. That's what a feasibility study, market analysis, even travel to go and find like you're the right location, where's going to be the right place for me to start this business. All of that can be written off in the first year as to, starting the formation organizational cost of the business. And I do want to say that in the first year, you can only deduct up to $5,000 in the first year.
Interesting.
So if you have over $5,000 in startup and organizational costs, the remaining amount of money will have to be amortized over the next 15 years. So it means you can write that off over the next 15 years of the business being.
That's wild. That's wild. Okay. So we can, step number one, we can write off our startup expenses.
Yep.
Pretty sweet.
So if you're sitting there and you're looking at the LLC and you're like, oh man, to open up an LLC and to have these people do it, it costs like $300.
Yep.
Which, yeah, it's about right. About $300. Then I have to get a website. I have to buy the website. I have to get some legal fees. It's going to cost like $1,000. Well, remember that you get to write all that off at the end of the year. So that is a huge, that's huge that the government's trying to help you out there. So up to $5,000 you can write off in the first year that the business, even if it didn't bring any money, you can write off $5,000.
Yeah, that's pretty sweet. That's pretty sweet. I like that one. So that's a good starter move. What do we got for number two?
Number two, I always like to tell people to write off is vehicle expenses.
Common one. I already knew this one. But please go into detail. Do tell.
So if you use your vehicle solely for business purposes, then you can actually deduct the entire cost of operating the vehicle on your taxes for this year. If you use it for both business and personal, though, it gets a little bit more murky in that you have to write off only what you use for business. So say you use half for business, half for personal, and you get to write off 50% of your vehicle for businesses. 50% of your vehicle doesn't get to get written off because it's for personal reasons.
Makes sense.
And there's actually, it makes sense, right? You can't write off your own personal vehicle and say like, hey, I don't want to pay taxes on this because I had to buy it. But for the business, you certainly can. And there are some different ways of writing off a business. Like I think if the vehicle is over 6,000 pounds, then it qualifies for an additional expense to be able to write off on a taxes. But there are two different ways of deducting your vehicle expenses, and you get to choose which one gives you the greater tax benefit. So this is really where we're working with a CPA could really help you out to figure out which one of these two methods is best for you. And the first method is the standard mileage method, which if anything you're using for your business, any mileage you're driving, you actually get to write off 65 cents per mile driven in the tax year. But that also means that you are required to track all of your business miles that you're driving. So it's very important for every single tax write-off. Actually, let me preface this. Every single tax write-off you're going to take, you need to have documentation. You can't just say like, I spent this much and I think it was this. No, you need to have documentation because if you get audited, that documentation is what's going to save your ass from having to pay a bunch of money to the IRS.
You think we should abolish the IRS?
I honestly think we should have an easier tax system than we do, like a progressive tax system that just is what it is, or a flat tax rate.
Yeah.
But that's way above my pay grade. This is the system that we have, so we work with what we can control.
I don't know if you saw this, but there is an idea being floated around the GOP right now that I don't think will pass. But in theory, they would be eliminating the federal income tax.
Okay, I'm cool with that.
I'm cool with that. That'd be pretty sweet. That would be real sweet. But the state tax is still pretty high. depending on. But still, that would be rad. Can you imagine?
My only concern is if they do that, so say they eliminate federal income taxes, they're going to have to tax somewhere else.
Yeah.
So where are they going to start taxing?
Yeah.
You
Probably
know,
increase sales tax.
they're going to have to figure it out somewhere. But like that's so many people, they'll look at the first order consequence, but what's the second order consequence of that? And, you know, it's the devil I know or the devil I don't. I don't know. If I have to look into it and see which one's deeper.
Yeah.
So whenever we're deducting vehicle expenses, we can either do the standard mileage method we just talked about, or we can do the actual expense method, which is a little bit more complicated, but I typically recommend it for people. So what that means is you have to track all costs for operating your vehicle in the year, including gas, oil, repairs, tires, insurance, registration fees, maybe even lease payments or mortgage or payments, not mortgage payments, but you know, payments for the vehicle itself.
Yeah.
And then you need to multiply those expenses by the percentage of mileage that you drove for your business. So it can be a bit more complex, but for an example, if you drove 1,000 miles under the standard method, then you get to write 1,000 or 65 cents times 1,000 is what, $650 you can write off. But if you had $1,000 did actual expense and then you leased a vehicle, you got to also write off the tires, the insurance, all of those things for the same amount of money. So while it is more work and more tracking of everything that you had to do, it can often save someone, you know, $2,000 on a tax write-off rather than $650 that the standard miles would do.
I don't know if you've heard about this, but I heard that business owners are now wanting to lease vehicles because it's more cost effective than buying it.
Yep.
Because it's, you know, you can write that off even more than a regular one, correct?
Yep, because you can write off the entire amount.
Interesting.
Yeah, because you're not owning the vehicle. Yeah, so it's the entire thing is a business expense.
Interesting. You see me rolling up like a brand new Ferrari, you'd be like, what was going on there? Oh, James, LLC. No.
Yeah. But remember, you still have to be able to make the money in the business to be able to afford that thing too. And you're still spending a bunch of money in order to save yourself a little bit of money on taxes. So, you know, if it's required for the business, then it's required for the business and go for it.
Yeah, if you're going to make the purchase anyways, make the smart purchase. But, you know, you could focus more on just purely making more money in the business. So, it's going to affect the bottom line probably a little bit more. So, okay. So we got the vehicle expenses, the startup costs. Those are pretty solid ones. I sense a marketing one, possibly.
Yeah, I sense a disturbance in the force and that there might be more. Yeah. So, yeah, one of the biggest things that new businesses have to expense money on is marketing. So marketing, advertising, you know, you go ahead and you create this new LLC, you have this new business idea that you want to bring out into the world. Well, no one's going to buy it if no one knows about it. So the biggest thing that most first year businesses are spending on is on marketing, advertising. So that could be SEO optimization, Facebook ads, YouTube ads, magazine ads, billboards, whatever it is that you want to have out there. You get to write off 100% of all marketing and advertising expenses are deductible in the year that it's taken.
Simple enough. I mean, you know, I wonder how big marketing departments at these major companies would be if they weren't deductible. I think they'd be a lot smaller.
Probably. Yeah, a lot more lean.
Yeah. A lot more lean. Yeah, I bet. Interesting. Yeah, but go for it.
I was going to say the one thing you need to make sure that you do think about is that there is criteria that for your business, the advertising that you pay for has to be necessary and ordinary for a business in your same niche. So say us here on the Fi Guys, we can go ahead, we can get Canva, we can pay for SEO, we can pay for whatever we want if we want to do that for the business. What we can't do is we can't go and buy a bunch of gold bricks, put the Fi Guys logo on it, and start handing it out to people on the streets. The IRS would definitely say that that is not ordinary or necessary expense for advertising.
Y'all are just idiots.
Yeah.
Okay.
So you really need to avoid extravagant or unrelated expenses.
Gotcha. I know that one is kind of That one's kind of shaky too, because I know a lot of people that will buy like supercars for their, video production business, or like maybe they're like a content creator or whatever. And they'll buy that and they'll put their name on, they'll brand it and everything, and they'll claim it as advertisement. Doesn't work.
Typically, it will not. So remember, if you get audited, this is where people kind of lose it. And unfortunately, they take a lot of advice online. And same like here at the Fi Guys, and they'll hear small snippets of the entire conversation, and they'll take that as doctrine. And they'll be, all right, we can go ahead and do whatever that person said to do. But you might be able to avoid the IRS for a long amount of time. Maybe you go ahead and you buy that Ferrari, and we put the Fi Guys on it, and we write it off on a tax expense. But in 3, 4, 5 years, the IRS could audit us, and they can go back as far as they want to on your LLC. I think it's up to 10 years. So they can go back there. They can see that Ferrari that we bought, and we put the Fi Guys logo on it. They can go, this is not this business expense this is extravagant. It's unrelated. It's not necessary. It's not ordinary. And now the burden of proof typically with law is that we are innocent until proven guilty. When you're dealing with the IRS, you are guilty until proven innocent. So you need to prove to the IRS agent why that vehicle was necessary and ordinary for your business that you run. And if you bought a Ferrari and put the Fi Guys logo on it just so people can see it driving around, I'm going to guess 9 times out of 10, you're going to lose that argument.
Yeah. And it's not like you got a jury or anything to convince. You got like one guy in a room who works for the IRS hunting people like you every day.
Yep.
Yeah. Damn. They're ruthless over there, man. You need to relax. Okay, so we've got vehicle expenses. We got startup costs, vehicle expenses, advertising and marketing. It's good. That's a good tip on the gold brick one, though. Now I know.
Yeah.
Can't put my name on a gold brick.
No, I shouldn't do that. I shouldn't do that next time.
Now I know.
I think the next big one that a lot of people get excited about is the home office deduction.
Yeah.
So, how many businesses are started out of someone's garage, out of someone's office that you're working individually? I mean, some of the biggest companies, Microsoft, Nike, Google, Apple,
Disney,
all of them started out of somebody's garage. So if you're someone who's working out of your home office, I mean, we're both working out of our home offices right now. Like, you are at the feet of Titans. So everyone started around there inside that same area. And one of the nice things is if you do work off, you actually get to write off whatever it is that you're using if you have a place inside your home that is used primarily for business reasons.
Yeah, that's one of my favorite deductions, to be honest. It's the one I use every year, obviously. I love that one. Yeah. Big fan. Whoever made it, I need to send them a cake or something.
Yeah. So remember that whatever area that you find in your home, it needs to be regular and exclusive use for your business.
Yep.
So that doesn't mean that like every so often I write a blog on my couch. Every so often I write a blog in my bed. So I get to write off both the square feet of my bed and my couch. No. So like this office that I'm in right now, for those of you on YouTube, I get to write off from this wall here to that wall there, to that wall there, to that wall there.
Done deal.
So I get to write off all of this room inside here because this is the place that I do my business for both Monzon Wealth and for the Fi Guys. It's all done right here, and I get to write all that off. Another thing that's very important is that if you're going to take the home office deduction, that your home needs to be the principal place of the business. You can't have an office somewhere else that you're renting inside of some, not fancy high rise. You can't take that deduction and also take a deduction at home. It's one or the other.
Interesting. It's good to know. That's good to know. I like that. Excuse me. I like the high rise one. I like the high rise on there. Yeah. Makes sense.
And then also another thing to keep in mind is that employees do not qualify for this expense. So if you have multiple employees working for you, you cannot write off their office at home as a tax write-off for your business.
Imagine. Next time, send me your square footage.
Yeah. But these deductions can be really, really helpful. So say you rent, you can actually write off the rental, or you can write off part of the rental. You can write off mortgage interest. You can write off homeowners insurance. You can write off HOA fees, utilities, property taxes.
Property taxes. Okay.
You write off all of those things and those expenses. Again, don't do this on your own. You need a CPA to figure out this stuff for you. I'm not going to tell you to go ahead and just start trying to figure it out, but this is certainly something you can do.
Absolutely. No, that's exciting.
And then
exciting. Dude,
And then
I love a good hack. I gotta say,
Mhm.
I love a good hack, especially when the hack is against the government. Mainly the taxes. Everything else they can get it, but yeah, okay. So I'm loving that. You're on a roll. You're killing it.
Yep. Well, hold on. Before we move on to the next one, I want to make sure that
Right.
we cover this. So there are, just like with the vehicle, there are methods for claiming home office deductions.
Okay.
There's a simplified method where you can do a maximum of $1,500. So that means, say my home is a rental, right? And I have to pay $10,000 a year in rent. I have great rent. I have a great landlord. He loves me.
Yeah.
$10,000. And my house or this office makes up 10% of the house, and I'm paying $10,000. That means I get to write up $1,000 off a year on that. That's the simplified method. The other one is the actual expense method, which is could give you a far larger amount of money that you get to write off, but it requires very diligent record keeping. And that's where you're looking at how much you paid in HOA fees, how much you paid in all of these other fees and taxes and everything else in order to write off a substantially larger amount for your taxes. But you do need to work with a CPA at that point. Like, don't listen to the FI guys and be like, I'm going to do the actual expense method, because there's a lot more record keeping that you need to make sure that you're keeping. So in case you get audited, you don't get destroyed.
Yeah. Nobody likes to get audited. It's kind of a scary thing to happen, but once you've been through it, it's not as scary, right?
Yeah. I don't know. I've never been audited for my business, so I don't know. I'm going to try to avoid it as long as I can.
Mhm.
One thing to think about, though, if you do take the home office deduction, it puts a red alert on the IRS. So taking the home office deduction does increase your chances of getting audited by the IRS. So you really want to make sure that you're sticking within the rules and that you have like a domicile in your home that you can say this is where I do that. And that could honestly be a desk that you're writing off. But if it's just a desk in a room and that room is also the kids' playroom and all these other things, you're going to really be running the risk if you want to write off the entire room. So me, I get to write off the entire room from here. And for those of you who aren't on YouTube, there's a closet back there by my back wall. I do not write off the closet because the closet has stuff inside there that has my wife's stuff inside there. But everything from the closet this way and to that way is all part of my office.
Makes sense.
So it gets that specific as to, I'm not going to write off the additional, like, I don't know how many square foot that closet is. I'm not going to write that off because it's not worth the risk to me.
No. Not worth it.
Mm-hmm.
Okay. People are actually writing off their closet is crazy. Yeah, they'd be wild out here. Anything to save a buck, right?
Yeah, anything to save a buck. And then after that, I think the final thing is maybe someone who listened to us and they said like, oh, well, I don't want to work for my own home. Maybe I have kids at home. It's too crazy.
Yep.
And I have to rent a place. I have to go to WeWork or wherever and I have to rent. The nice thing, if you do rent an office, that is fully deductible. All commercial office rentals is fully deductible in the year that you paid it. So that means associated costs, utilities, maintenance, anything that you had to do in order to improve the building to make it your own, that's all write-offable inside the year. Say you had to blow out a wall or something like that inside of a rental office, and you got approval to do that before you went and just blew a freaking wall out, but you got approval to do that, you get to write off that full expense.
Interesting. Yeah, I like that. I think it's important to learn these things, especially if you're starting a business. And even if you already are in business, it's always good to have a little refresher. Because sometimes we forget as business owners. And we got to be reminded, you know?
Yeah. I mean, let's think of someone who wants to go ahead and open up a business in like a strip mall, right? So say, hey, I'm really good at doing taxes and there's a strip mall that has a little office available over there. And I think I can do that. Well, one of the nice things is I can go ahead and form my LLC, get a tax write-off for forming the LLC. Then I go ahead and I rent that office, write off the entire amount of renting that office. Well, now I need to do advertising. So I put out a circular inside the newspaper saying, hey, Dom's Tax Services is here at this location. I get to write all of that off. And then I will need to go ahead and put advertising on top of the building, right? So now I'm paying for advertising, and then I'm also making changes to the building, get to write that off 100% as well. And then anytime that I'm driving my vehicle from work or from my home to my office, as long as I'm tracking those miles, I can write off that as well. So you can see the power of stacking these things on top of each other in order to really get maximum amount of savings. Because the more money you save on taxes each year is the more amount of money that you can put into your business or more money that you can put towards giving your family the life that they deserve, or you or yourself the life that you deserve for all the hard work that you're doing as an LLC owner and as a business owner. Because as we all know, and we've talked about it here on the podcast, owning your own business is substantially harder than working for somebody else.
It really is. It really is. It's tough out here in the trenches. It really is.
Yeah, I know it is. So before we move on to all of the comprehensive list of all the things that you can write off, I want to go ahead and talk about that you need to stay on top of your deductions. So it is so important that if you own your own LLC, that you have ongoing bookkeeping. And luckily, there are so many bookkeeping services out there that you can go. I know even like TurboTax has their own now. I use an app called SimplyWise that I pay for, that I just take expenses because I'm a sole proprietor and I just do everything myself. But there are so many different ways that make sure that you're keeping diligent records of every single year. And I think it's up to 10 years, maybe 7 years, depending on the state that you're in, as to how long you get audited for. So you need to make sure that you're keeping records of everything. I keep all mine digitally. I don't like to keep a bunch of paperwork, but that's where you'll go to someone's office. They have boxes and boxes and boxes of just receipts. I think that's dangerous, and I wouldn't want to get audited and pull out boxes of receipts. I like having everything digital, but there are different strokes for different folks, and whatever works for you. But just make sure that you have a system.
Yeah, absolutely. I use QuickBooks, monthly charge, but dude, it's so easy when it comes to tax time. It's like I have automation for like, okay, when Adobe charges me for, Photoshop and different things, it's like it automatically goes towards like, oh, this is a software expense, right? And it's like that way I don't have to go in and every 12 times a year I have to go in and like check it. It's like, no, it just automatically does it. I love it.
Yep.
I love it. I could not run a business without me personally.
Oh, yeah. I don't run it with QuickBooks. Maybe at some point I will have to, and I've thought maybe I'm getting to that point. But for me right now, luckily, as a financial advisor, I don't have a lot of expenses that I'm paying for very often. So it makes it pretty easy overall. But, that's where if it is really, really becoming a headache and, maybe even QuickBooks isn't enough for you, you can always look at like a professional bookkeeping service, and then they can be the person who tracks all the expenses, provides accurate record keeping, and holds everything for you and does it all for you, so you don't have to deal with that. But again, remember, that's an expense. But even if it is an expense, you can write that off.
Exactly. Did you catch that one, guys? Did you predict that one? I hope you did. Hope you guys have been listening. Yeah. Even if it's weird that the software that I use to calculate my taxes, I can write off. It's such a strange system. Such a strange system, but hey, I like it.
So before we finish off the podcast, I want to give you a comprehensive list of every single small business or a small tax deduction that people can go ahead and take, just so you know what they are. So some common or the most common deductions that all small businesses can take. We already talked about this one, but advertising promotions, you can write off 100%. Business meals. So taking clients out to lunch, taking your friends out to lunch, taking whatever, no, not your friends, sorry. Your friends, if they're going to become business potentials, you can take them out. But just so you know, you can only generally deduct 50% of food and beverage costs. So that means you're paying for the other person, not for you. Now, what this is meant, but there are ways to go around this. So often as a financial advisor, when I take out clients that are a married couple, it's me taking out one person, taking out a married couple. So I only get to write off 50%, and I'm not going to eat 50% of the meal if I'm taking out two other people. So oftentimes what I'll do is I'll take my wife with me as well when we go out on meetings with couples. That way I can write off 50%. So I get to write off at least mine and my wife's entire meal.
Yeah.
So there's a little trick there. You can take somebody else with you or take another person from the business with you. And sometimes you'll notice that, right? Where you're with your boss and like, hey, I'm going out to lunch with this person. Will you come with me? Well, they're doing it to be kind to you, but also they're doing it because they know they get to write off 50% and they want to maximize that write-off for themselves.
Damn. Tell me Steve in accounting is lying to me? What is going on here?
Yep.
Get me, Steve. Get me. Yep. Okay.
And a big thing with meals you have to remember, just like with everything, is it needs to be ordinary and necessary part of carrying out your business. The meals cannot be lavish or extravagant under normal circumstances. So if you run an accounting practice and you're taking your person that some new client out to Ruth's Chris, or every client that you meet out to Ruth's Chris every single night, that's not going to fly. Like, it needs to be ordinary, and it cannot be lavish. It just needs to be normal stuff.
No, like $6,000 bottles of wine, stuff like that.
Yep.
Gotcha.
And then another thing that's very important is that in order for you to take that, either a business owner or an employee must be present at the meal. So you can't say, "Hey, Dominic, we had a great podcast today. I'm gonna send you, I don't know, a DoorDash to your house."
Yeah.
I can't write that off. I need to be there at the meal. If I brought it to you and then we ate it together, then yes, I could write that off.
What if you send me the DoorDash and we're having a meeting over Zoom?
You can talk. Yeah, I don't know. Maybe you could do that. Yeah, because they do lunch and learns. I would assume that would work. Because we're not physically present, but we are like present.
Yeah.
I think that would work.
Okay.
Again, remember, a lot of this is is like having a debate with an IRS agent.
Yeah.
So you can really make anything work.
Pod if we could get an IRS agent on the podcast.
Yeah, and then just like try to see what we can work around.
Yes. 2 weeks later, we both
pretty funny. Yes, yeah.
God damn it,
we screwed it up.
We messed it up. Sorry, Lord.
Other things you can write off: business insurance. All insurances require business insurance. I have E&O insurance. I have quite a few different ones. You can write off all of that. Business interest and bank fees. So hopefully, if you have a business bank account, you're not paying fees for that. But if you do one, you can write off all of the fees there. Business use for your car. We already talked about that. You can do that. Contract labor. So if you have to pay for somebody to come into the house or to come into your property and do anything where they're building something or anything like that, you can do any labor. So even contract labor for maybe you have a product that you're building and you need to buy out to another place for them to try to create a new design or something like that. 100% tax deductible. That's a normal business expense. Depreciation is a really big one that we should talk about. Yeah. And again, you want to use a CPA for that. So say when you purchase furniture, equipment, or any other business asset that is required for your business, you get to depreciate the cost of that expense over years rather than deducting the full cost in a single hit. So depreciation of how you do vehicle or how you do different things all depends on the life cycle of that specific thing that you purchase. So that's where a CPA is required, because I can't tell you how long a depreciation on a chair is versus a depreciation on a desk. Like they're two very different things.
Yep. And the life cycle of, different products matters, right? Because if I had like a diesel or a truck for the business, well, that might last me 15 years, maybe 10 years, versus like a box of pencils. I might blow through that in a month or two. So it all depends, right?
Yep. Next thing we can always write off is education. Really? So one of the biggest things that everyone should be doing if you're a business owner is constantly trying to develop your skills and make yourself better. So you can write off any education. So even if you and I were to do something online, like buying a online course, you could write off that entire course for taxes. And even like going out to places, you can do that as well. Going to a conference somewhere, you can write off the full cost of that conference. The next thing we already talked about was a home office. We talked about that. Any interest on any debt you can write off as a tax. So if you had to put things on your credit card in order to get the business going for a little while, all of that interest, that 20 or 30% interest, you get to write that off as a tax expense. Please do not put yourself into debt in order to get a tax deduction. That is stupid, but you can do that. Legal and professional fees, we already talked about. Moving expenses. So if you need to move your office from maybe a home office or to a normal office, you can go ahead and pay for all of that, including all the moving fees, all the movers, having the truck be delivered, all that stuff could be written off. Rental expenses, your salary and your employee's salary and their benefits, that all gets written off as well. So whenever you hear someone saying like, "Oh, wow, I just got a promotion or I got a new raise for no reason, and now they're going to be matching my 401k," the reason they're doing that is because they get tax write-offs for all of those things. Yes, it's out of the kindness of their heart. Yes, it's because they want to retain you. But remember, they're also getting incentivized. Your business is getting incentivized to do those things with tax write-offs. Next thing, telephone and internet expenses, all of that get written off, and travel expenses can get written off. And travel is one of those other ones I want to talk about where you have to be very cautious on it, and this is where you really want to work with a CPA because you have a lot of travel things, it is a red flag for auditors. If you are going on a business, if you have to travel for a business expense, I have to go to a conference, I have to go do something like that, and it is ordinary and necessary for your tax or for your business, then it is okay to write off the full amount that you had to do for travel. But if I want to go to a conference in Hawaii, maybe Oahu, and then go out there and pay for a conference that's out there, I can do that. But if I go there and I stay in the Ritz-Carlton for 2 weeks, and during the entire time I was there for those 2 weeks, I was eating out at the fanciest restaurants every single night, I cannot write off that whole thing. That would be a 100%, like there's a good chance I'll get audited for that. But if I just wrote off the flights there, staying at a hotel for a night or 2 nights, and for the conference and for 3 or 4 meals a day, that's going to be totally fine. So remember, that's when you really want to work with your CPA or with someone who works with this stuff every single day to know what you're doing, to make sure that you're not going to put yourself at increased risk for audit. Another thing to be important to know when it comes to the travel expenses is the place that travel was dictated to cannot be your city or area that you live in. So living here in Phoenix, Arizona, I can't write off a travel expense to Scottsdale and like staying in a hotel in like Scottsdale, a different part of Phoenix for those of you who don't know.
Mm-hmm. Mm-hmm. Interesting. Wonder why that is. Why can't I write off travel to another city in the?
You can, but it can't be inside the surrounding area. So you could. Why are they going to let you write off a tax deduction for something you could easily drive to?
I see.
It's that in the same city. Just drive there. Now, if you need to go to a different state or something like that, that makes sense. Or if you need to go to a completely different city in general, that makes sense. You know, if I had to go to Tucson, I could write off going to Tucson.
Yeah.
But me being
Tucson's,
in Central
for
Phoenix,
those that don't know, Tucson's like 2.5 hours away.
Right?
Yep. Okay.
Yeah, or think of people like most people know the difference between like LA and San Francisco, right? Like though they're 2 very different locations,
Yep.
Southern California versus Northern California. If I'm in LA and say I have a place that I'm in Long Beach and I need to go to Orange County, they're sister cities. I can't write off going to Orange County because I could just drive there, and they're both in the county of LA. But if I had to go from LA to San Francisco, I can write that off because there's no way I'm driving from LA to San Francisco in a day. I mean, no. I can make it in a day, but
coming back
after that, I'm done.
Yeah. Okay. So that makes sense. What about stuff like personal expenses?
Yep. All the personal expenses can be written off.
And what is it like? Okay. Obviously, like, got a haircut. Could I write that off?
If you can make the argument that it is required for your business, you can. So say for the Fi Guys and say like I'm on camera every so often, like this often, yes, you could write it off. But again, you're not making the argument to me, your friend.
No.
You're making the argument to the IRS.
Yeah. Chris will give me all the the write-offs I want. But Chris is also not the person auditing me. So
And that's where things get really sketchy really fast, right? Is so many people say like, oh, well, my dad, I have a friend who has an LLC and he does all these things and he writes them off. And I get unsolicited business advice all the time from people. And I always say, if that works for them, that is great. I'm so glad that does. But I'm not willing to take that level of risk on my business. So you have to ask yourself, and that's where it really is important to work with a financial advisor, work with a CPA, work with someone who knows this stuff, and make sure that you're not increasing your risk for audit or increasing your risk for getting your business shut down by doing stuff that's sketchy. Unfortunately, most of the information that you see on TikTok is completely wrong.
Yeah. A lot of people, just because they're successful, give financial advice, but they don't understand how much luck goes into being successful versus someone who, like Chris, who is he's certified. This is what he does. Fiduciary. Like, what are we doing here, guys? It's the finance side of TikTok can be very annoying sometimes. Very annoying. Ugh. We've been on TikTok.
And that's the hard part, right? That's the reason that we have a full hour-long podcast every week or 2 hours every single week is because these things can't be broken down into a second clip. If I said that, hey, like the only way I can make a short TikTok of like tax deductions is saying like you can write off your full office expenses, and then it'd have to go away. But that doesn't mean that that's not also including the fact that like I can only write off if it's a full office that I'm only using and only these dimensions within this house. There's so many different ways. And then like, which method am I going to use to deduct the office? Am I going to do the standard method or the more accelerated method? I don't know. If I want to write off my vehicle, am I going to use the standard mileage method or the maintenance method? I don't know. And all that stuff is a much more nuanced conversation than what someone could put into 30 seconds on a TikTok video.
Yeah. Yeah. Absolutely. Absolutely. That's a lot of stuff to think about.
There is. So I think it's important that you always make sure that you're utilizing the available deduction that you have at your disposal to you. The IRS gives you this because they know that starting a business is very difficult to do. And if they're going to be nickel and diming you as much as they can out of taxes, they know that most people aren't going to make it off the ground. So it is possible to have a business that is making $100,000, $200,000, $300,000 a year and pay $0 in taxes. So when someone says, oh, it's not fair that Amazon pays $0 in taxes, well, Amazon isn't making any money. It's because they're putting every single dollar that they make every single year back into growing their business to make it faster, better, stronger every single year.
Yep.
Is it fair? I don't know, but this is the law that we have. This is what we have to work with. So we deal with it.
Yeah, exactly.
And please, followers or everyone who's listening to the Five Guys, stick to the IRS guidelines strictly. Make sure you work with a CPA to make sure that you're not taking random deductions that are going to increase your chance of audit. Because while I've never been audited, I've talked to many business owners that have been audited, and they say that while it's not the worst thing, it takes you away from your business. And anytime that you're away from your business, dealing with other BS is time that you're not making money.
Bingo. That's so true. He's hitting it right on the head today, guys. Good Lord. Okay, so I think that we want to summarize the key points. I think that's all of the expenses, the write-offs that I can think of. You don't have any more, right?
Yeah, no, that's all of them.
Yeah, that's all of them.
Yeah, that's all of them.
Okay, that's good to know.
Yeah. So
yeah, let's do it.
The major ones that everyone in 2024, if you're a new LLC, should be doing is, first off, startup and organizational costs. You can write off up to $5,000. And if your startup and organizational costs are over $5,000, I think you're kind of being a little excessive, but it is what it is. You can write off the remaining in the next 15 years. Then there's vehicle expenses. You can write off 100%. If it's 100% for your business, you can write off 100% of the vehicle expenses. Next is marketing and advertising expenses. You can write off 100% of that. Home office deduction. First off, you need to have a place in your home that is the principal place of your business that you do regular and exclusive work for your business in. You can write that off. 100. You can write off that amount of the house that it's taking up. And then you can also write off 100% of office deductions. So if you have a commercial office that you are renting, you can write that off. And if you want to hear all of them, I would say go into the description. We'll have more links in the description of everything that we're going to talk about there. So go there. You can reach out to me, Chris at Monzon Wealth. If you have any other questions, I'm always happy to talk about it. I am not a CPA in any way, shape, or form, but I am pretty aware of this because it is my job.
Absolutely. Well, guys, if you guys are already still here, make sure to like, subscribe if you're not already subscribed. Tell a friend. We would really appreciate that. If you guys could go and tell a friend. Do we have any action steps for this week? It's kind of a weird one to have an action step.
The action step is if you do have an LLC, make sure that you go online, look up all the tax deductions that you could be taking, and then make sure next time that you meet with your CPA that you ask them about these things. Am I taking all these deductions? You need to be your own advocate. So make sure that when you talk to the CPA that you ask the question, am I taking advantage of as many deductions as I possibly can? Because if you're not your own advocate, no one's going to be that for you.
Bingo. Well, guys, I hope you guys enjoyed today's podcast. This is the Five Guys, and we'll see you on Friday for Five Friday feedback with a little viewer mailbag on the end. But yeah, go forth and prosper.
You and leave up to a 5-star review here on Spotify, YouTube, anything. Exactly. Until next week or until Friday, I guess. We'll see you later.
Bye, guys.
This video podcast is sponsored by Monzon Wealth. The content in this podcast is for informational purposes only and should not be considered financial advice. We do not endorse specific products or services. Past performance does not guarantee future results. The opinions expressed are those of the hosts and guests, not the podcast sponsor.
It is crucial to consult with a qualified financial advisor or professional who can provide advice tailored to your specific needs before making any financial decisions, investments, or taking any other actions. If you are seeking specified help, you can reach out to Chris at monzonwealth.com.